Hello, today we're going to discuss support and resistance levels, what they are, how to find them, why they're important, and how to trade them to make money. I'll show you real examples on different time frames. Let's start with what they are and why support and resistance levels are probably the most important things to look at first when trading, and at least why I pay special attention to them. Take a look at the description. There will be a link to register on the Bybit exchange. This is the #1 exchange that I personally trade on, and it's the top one in terms of trading volume, liquidity, and it has the lowest fees. Just from this, you'll save around a few $100s every month. And why do I recommend registering specifically through my referral link in the description? With it, you'll get a cash bonus for registration ranging from $10,000 to $30,000, depending on the size of your deposit. Most of my subscribers get $100, but if you don't have any deposit at all, you'll at least get $10. If you're a big trader with a good deposit, you can get up to $30,000, but for larger amounts, you'll need to reach a corresponding trading volume. On this page, just click here, and you can see what bonus you'll get for registering. If you're a big trader, the good deposit, you'll get up to $30,000, but for larger amounts, you'll need to reach a corresponding trading volume. On this page, click here and you can see what bonus you'll get for registering. The link is below. Enjoy watching. It's not hard to guess, especially if this isn't your first trading video, that support and resistance levels are basically horizontal lines. Specifically two, for example, I've drawn one here and another one here, which somehow magically influence the price. That is, if the price approaches the support level from above, it is highly likely to bounce off it upwards. If the price approaches the resistance level from below, there's a good chance it will bounce back down. If there isn't a bounce and a breakout happens instead, usually after breaking through resistance or support, the trend accelerates in the direction of the breakout, either up or down. Usually situations like this happen. Let's figure out. First and foremost, this is extremely important. That's why a bounce happens at certain levels or acceleration occurs after a breakout, because let's imagine a situation where I don't know, am some kind of hypothetical pension fund, and I have $1 billion that I need to invest in Bitcoin according to my plan. For example, let's hypothetically assume a situation where I, as a manager, have to decide what to do. Go to the market, to the exchange, and place a buy order right here and now at any price. It doesn't matter, I want to invest $1 billion. No way, of course they'll tell me, you're an idiot, you're fired. So what happens the moment I click the button to buy $1 billion worth of Bitcoin? That's what will happen. A spike will occur, and then it will drop back down instantly. So I wouldn't buy at the current market price, but rather at some ridiculous price with slippage, and instantly millions, actually tens of millions of dollars would just vanish into thin air, just because I clicked that button. So that's not how trading on financial markets works. How does it happen? I have a certain comfortable level for buying. For example, it would be comfortable for me to buy in this range. So what do? I place pending orders. Buy at this price, buy lower, maybe buy a little bit now, not for $1 billion, but buy at some lower prices. And the lower the price, the more attractive it is to me. Well, it's clear that there are certain deadlines by which I need to build my portfolio, right? So based on that, I identify some approximate price range for myself. And somewhere I'm already placing a pending order for part of my balance at a lower price. Price drops, I have a 100 minutes order. Until sold, price stays. After selling, it drops. I have 900 mem or 800 if I bought. If price falls below my order, I buy. At a comfortable range, I might buy 100 mes at market, causing a rise. I execute sell that I placed, and only if they sell off those 100 million does it drop down, and I still have 900 million left, or maybe I bought a little here, so I have 800 million left. I see that the price has even fallen below my previous order, so I start buying. And already at such a drop, when the price reaches that comfortable range for me, I can even buy a little bit at market price, like 100 million. And the price jumps up because I have to buy from someone. There are some sell orders in the order book and I execute them, and that's when the price starts to rise. Then I place another order for 100 million at an even lower price, and if suddenly the sellers become active again, so they'll sell me another 100 million here. And here, for example, there really is a big seller. A truly huge one, wanting to sell for $1 billion, or maybe even for many billions. But what's happening? Let's remove what I drew. The ranges that are favorable for me. Look at what was happening. So, for example, the price was moving like this, and I was buying, and then I actually bought $1 billion in a range that was comfortable for me. And at that moment, the price starts to rise because I have to buy with a lot of money. What's happening? Look, here the price was dropping quite quickly. Because, well, let's say there are no other market participants who really want to buy in large amounts. And there are a lot of sellers, really. Everyone wants to sell Bitcoin. And the price is really dropping sharply. Where does it start to stop in its movement, in its decline? To start with, it's at the level where I had my first big orders. Why? Because as long as they haven't been executed, the price won't go down. And here they are, my first big orders already affecting the price. Like, well, a certain level, a certain line right here that the price couldn't break through. Moreover, that was the support, and the price went a bit lower. So for me, this is a comfortable level. This is a comfortable price. As a buyer, I'm kind of protecting a certain range and buying. And you see the price, it was actively going down here in this range. It dropped down here quickly. It had the same drop down, it didn't fall at all. And also during the drop, it stayed here for a long time. And this is assuming that there weren't really any buyers around except for me. If there were buyers around besides me, well, it wouldn't have stayed here at all. Even if it came here, it would have shot up instantly because, well, it's already corrected. It's more profitable to buy than it is here. And the buyers would have swooped in. Well, let's say there were no buyers. Well, it's standing here. Why is it standing here? Why are there certain zones below which it doesn't fall? Because big capital is placing orders. And if we trade based on certain patterns, trends, or indicators, all of that directly influences people's decision making. However, support and resistance levels affect the price directly because they physically exist in the market's order book. There might not even be one of my orders in the order book. However, support and resistance levels affect the price directly because they physically exist in the market's order book. There might not even be one of my orders in the order book. So I only placed an order for part of my balance here. But it appears later as soon as I see that the price has dropped. And where would I ideally want to buy? Ideally, I need to buy lower, but it's clear that if I'm a trader analyzing the market and I set a comfortable range for myself right here, what's the likelihood that the price will actually get down to this level? Well, it exists, of course, but while it's going there, I have deadlines, remember? I have a comfortable price range and deadlines by which I need to execute my balance. And why would I place my order here if I see that there's a level other market participants have previously bought back? The level is strong. I'll wait a million years for the snado to reach me because there will most likely be large applications in front of me. And if those big orders get sold off, market speeds up. So I'd rather buy above support. Timing-wise, there won't be much difference if they sell to this level. In terms of timing, there won't be much difference if they really do sell off down to this level. But if I'm really pressed for time, I need to set my comfortable range just above that support level. And the closer I am to the level, the better. But if I'm really pressed for time, I need to set my comfortable range just above that support level. And the closer I am to the level, better. So levels are kind of self-emerging, forming. As a trader, I support these levels with real volume. And remember, the better a level looks, more traders and bots see it, the better it will perform in the market. Levels play out in two ways. As I mentioned at the very beginning, either there's a bounce off the level, which happens most often, or there's a breakout followed by a trend acceleration. Both of these scenarios will work out better. Stronger the level is and the more people see that level on the chart. You understand, right? So we figured out why levels work and we won't dig any deeper into that. Let's talk about how to build them, and for that let's switch to some smaller time frames where my chart isn't marked up. I'll show you right away with examples. And not straying far from the point, the smaller the time frame, the more local the levels will be, and the worse they will perform compared to those we draw on larger time frames. More capital allows larger time frames. Small capital trades on minute charts with levels prone to quick breaks and false breakouts. Larger time frames perform better. With a small capital, you trade on smaller time frames like minute charts where you have tiny levels that get broken quickly, which might perform worse and can have a lot of false breakouts. That's where the nuances come in. But the larger the time frame, the better the levels will perform. However, even on smaller time frames, you can use them for your trading. So how do we draw levels? By the highs and lows, meaning the maximum and minimum prices. So if we have a maximum formed right here and suddenly there's another maximum, here that level, we can at least draw a small level based on those two. And the more touches in that zone, the stronger that level will be, at least 2. Sometimes actually you can even draw a level based on just 1 point if it's a super high. So to keep it simple, we can take a small level right here at the very maximum because it also coincides with the round figure of $100,000. That's the highest point and we bounced off it. It's clear that when we approach that same high again, there will be some resistance. People set their sell orders right at the maximum because they want to sell at the highest price. And if we break through it, we'll shoot up vertically because the hype will start again. Well, it's clear. In this case, yeah, here's an example where you can even draw a level based on just one extreme high. But usually at least 2, and if there are more, then that level will be stronger. If we're talking about 2 highs that we use to draw a level, but those two highs are just a bit short, reaching each other, right? This will basically be one level too, because remember I mentioned that there's a comfortable price range for me where I make my trades. And that will be one level. Most often I draw levels in cases where I see that the price doesn't reach exactly, not to the tick, but there's some seller right here. I draw the level roughly in the middle of those values. Larger time frames have bigger differences. Small time frames have levels close to highs and lows. On larger time frames, use rectangles. If we're looking at the smallest time frame, then indeed the levels can be, well, not exactly spot on, of course, but really close, like the price often approaches very closely to the previous highs and lows, and these locally small levels can be quite flat. On the other hand, on larger time frames, like daily levels, you might not even need to draw lines, but rather highlight a range with a rectangle. And that will work, and you need to take that into account. While on larger time frames like daily levels, you might not even need to draw lines, but rather highlight a range with a rectangle. And that will work, and you need to take that into account. So let me show you an example on a smaller time frame where we had some extremes, highs, lows, and the squeezes and breakouts that led to a trend acceleration, and that will work, and you need to take that into account. So let me show you an example on a smaller time frame where we had some extremes, highs, lows, and the squeezes and breakouts that led to a trend acceleration. It's clear to see with the naked eye starting from the left side of the chart. Yeah, we had some kind of, and as soon as we broke through that zone, the price accelerated. Let's see if that value worked out further. Here we can see that as we approached this same zone, selling started, meaning that buying began here. And where did the sharp selling start? As we approach this zone, great, let's move a bit further. Let's take a look. Yeah, look, it really worked out here, and one way or another you can highlight it. When we highlight a level and see that it has stopped working, like here where some kind of choppiness has started and no one is paying attention to this level anymore, we can stop drawing it further. So here it kind of lost its relevance. However, look here, zone is relevant again. So the price dropped and buying started. Where did the selling begin? Again from this zone. So theoretically you can draw it like that, but if there's a lot of choppiness at the level, I usually remove it and highlight a new relevant one. Notice the level we drew. When drawing levels, start from the left side of the chart. Look to the left to see buying and selling zones. And pay attention that when we start drawing levels, we do it from the left side of the chart, not just sketching something here on the right side. And to start, we look to the left at the recent past to see what was happening, from which zones there were any buying and selling. Here's a zone. Look, there was a high here, there was a high here, and we didn't go above this zone, we hit this point. On top of that, when it broke through, you see there was an acceleration of the trend. Well, here too, when it broke through, it dropped sharply down. Okay, here's a zone where there was also some interest from buyers and sellers. And by the way, I forgot to mention that if we have a support level from below, let's say somewhere around here, and the price breaks through it from top to bottom and goes lower, then that level becomes a mirror level and will act as resistance. On the contrary, if we have resistance here and the price breaks through it, that level becomes a mirror level and will act as support, from which the price will bounce off. This is it works, you can remember that. And there's a physical justification for this, because if the price has skyrocketed and I'm not in a position, well, where am I going to buy here? No way, am I stupid or what? I'll wait for a pullback. So where ideally will I be buying in? Well, it's around strong levels, strong zones. And the closer I get to a strong level, a strong zone, the higher the chance that I'll decide to build a position, and I'll build it with a larger volume. And from here, market participants building their positions one way or another. So let's get back to our levels. What else? We see strong zone right here. Look, as soon as the price dropped into this range, it started bouncing back up from where? From these extremes. We can draw a zone based on them. And notice, well, there were, of course, a couple of false breakouts here. Yeah, this one and this one too. But if we don't take them into account, we can smooth them out, yeah, as if the sleep went here. Look, it was sitting in the upper range, the lower edge of which was the same zone. So the price was sitting here at first, then it sat here. And it was resistance at first, then it became support. Let's highlight this level, and let's see what happened next. And it continued to play out. Look, this level was the upper edge right here. When the price approached it, they started selling off. When the breakout happened, what occurred was that the price broke through, did a retest, and that's called a retest. This is where the buying started, even a double retest. And so the price settled above the level and started trading in a different range. And well, it didn't go here, meaning the buyer was weaker than the seller. In this example, yeah, but also from this level, they start buying back. And as soon as the sale started, the price settled below the level. It already went under it. The trend is accelerating, you see? How do you understand that the trend is accelerating? Look at how quickly the price fell into this range, just in a matter of a few candles. But before that, there wasn't even a similar price movement, right? Well, half of this range was covered in how many candles? Well, in this case, it took 30 candles when the breakout of the level happened. The movement was twice as big in just 6-7 candles. Do you understand? You need to learn to see this somehow, and you'll learn to see this with experience. You'll learn to see these things with experience. Let's extend this level further. And what do we see? What do we see? The breakout of this level accelerated again and again. There was a false breakout, a false move. One way or another, this is also a pretest. This is where they started buying back. This level is still relevant. So if the price comes close now, buying could start from here. Maybe it will even get stuck here for a while. Maybe it will turn around from here. Or maybe the seller will break through this level, and if that happens, the price will drop down with acceleration. So we've identified this level, and now we're just sitting and watching. Also, if we see any trends or patterns that we draw based on highs and lows like this, those trends and patterns can change later on. I really like to draw local levels based on the latest lows. Well, in this case, lows, because we broke down, or if we're breaking up through some descending trend, then based on the highs, which can play out one way or another in near future. And it's not good to draw a level right on one extreme on one low because, well, you see this move didn't lead to anything significant. However, if we look over here at this consolidation, the lower edge is right here and we can draw a level like this. So what do we see? Well, they started buying back from this zone right here. You see, after this serious drop, that's where the buying started. The first one is based on the low, we bounced off it, and the second one is from this zone right here. This is where the buying started. Well, see, the price has settled below. Most likely, it will go up to this next zone. Do we have any levels between them? No. Oh, by the way, this level, it's right here. It was relevant here, as you can see. But moreover, this one is also based on these lows. Everything moves around the same values. There was just a small chop right here. Well, there was some chop here within this zone, and they also chopped this zone too. However, as you can see, this zone hasn't lost its relevance even here. So this is really local. Let's take a look at the more global ones, meaning these very lows, extreme ones. Was there any interest from the market? Yes, there was. Here's a zone, right here, a little lower, right here. This was a high here and a low here with a retest, a mirror level. They started buying close to this zone after this serious drop. There was a small chop here, but if you don't pay attention to it, focus on this area instead. We also hit right in the center here. There's a small chop again here. And after breaking above this zone, retest acts as support. Great, and we can extend this zone here. So if this zone doesn't hold, then this will be the next one. How do you trade these things? Okay, we figured out how to find them. How do you trade them? Most often bounces happen from a level. So if we say that we have a certain level and the price approaches it, it can bounce once, twice, 3 times. It can bounce off it an unlimited number of times, but it can only break through it once within a single trend. So we have this sideways movement, and within this range, this edge can have an infinite number of bounces, but only one breakout. Yeah, then maybe another trend will form here. Within that trend, there will be some more bounces or breakouts, but that will be a different trend. Within a single trend, within a single movement, including within a sideways range, there will only be one breakout, except for some false breakouts that might occur. But that's probably a topic for a separate video on how to avoid false breakouts. Why? Because I don't want to drag this video on for another 15-20 minutes. So how do you trade it? It's best trade bounces when we're in a sideways market. So if we see that the price is just sitting still without any upward or downward movement and it approaches a level, that's when we start buying. So let's say the price reached here, I would buy from this point, and there it bounces. Where would I sell at the next level? Well, either here or, in this case I didn't highlight it, but we have a good zone right here. You see, it's really, really good right here. Right here, for example. So basically, if the price stays within this range, you can start selling or shorting from this zone and take profits here. Set stop loss beyond zone. Shorting gives poor risk reward. Use small stop losses. Price is in sideways movement. It went beyond edge and broke out below. Shorting was profitable, but led to a loss. It's best to set very small stop losses when you're trading bounces. As you can see, we have a sideways market and the price is sitting inside it right now, but it has gone beyond the edge of this range here and it also broke out from the bottom of this range. So if I had shorted from here, I would have made a good profit several times, but here I would have taken a significant loss. Or I would set a very small stop. But even in some cases, it felt like I was getting stopped out in what seemed like profitable zones. That's why I don't like trading bounces. I trade breakouts in the trend. So if we see a trend that's not sideways but rather a directed trend, either upward or downward, and the price approaches a level, let's say we have a level in a downward trend, it might bounce off it, then consolidate a second time. At the moment of the breakout, I open a short position, as in this example. Or if we have a level of resistance, and the price approaches it within an upward trend, it might bounce a little, and then consolidate. This is where I would buy. That's how I've been trading most of the time, at least for the last 6 months for sure. And before I finish, let's switch to a larger time frame. I'll show you how the levels look on a larger time frame, so we've marked out the small time frame. Let's switch to maybe a daily chart, although it might be tough on the daily because the market is currently at some really good highs. Although you can really see the Manners levels here, especially on the daily chart. And you can see that we have this level, this zone, which you see had a high by how many percent? It's 5% different, let's say, from this high, but it's all one level, it's all one zone. I do highlight it as a line, but it wouldn't be a mistake to mark levels on larger timeframes as some kind of range. And if the price breaks through this zone, in this example I'm trading breakouts, ideally with a retest, then I go long. Either, well, this is when breaking out of a sideways market, right? Or as I said, if there was an upward trend here and it hit this level, pulled back, then started to consolidate again, I could enter during the consolidation without even waiting for a breakout with confirmation. Ideally, there should be a breakout and a consolidation, and it would be even better if a retest happens. So that's roughly how the market is structured, and that's how crypto works with levels. This is an obvious level that you can see with the naked eye, and I've highlighted it here. These two are actually one range as well. Yeah, it's one range. I've drawn these two levels from right here, and they are relevant in this trading range even here. You can also find some more local levels here. You see, we have a little sideways market here. One zone, two zones. You can also make some trading decisions based on these zones. Well, subscribe to the channel and don't forget, follow the links in the description to check out my other social media. In the Telegram channel, just a reminder, I have a free trading course pinned in the messages. If you don't know how to trade, you can take it and start your journey into the world of trading. Good luck!